market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the Federal Reserve Chair, Jay Powell, says the U.S. Central Bank has been served grand jury subpoenas from the Justice Department threatening a criminal indictment. The move is a dramatic escalation of the Trump administration's attacks on the Fed.
The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation.
Well, Donald Trump insists that he had no knowledge of the DOJ's investigation into the central bank. For more on this, we're joined by Bloomberg senior editor Alistair Bull, who covered the Fed in Washington for many years. Alistair, thank you for joining us. So first of all, how serious a threat is this to the Fed and its independence?
Good morning. It's an unprecedented assault on the independence of the Federal Reserve. This hasn't happened in the history of the modern Fed. But I think you need to ask two questions here. What's the Powell Fed going to do? And what happens once he stepped down as chair? His term as chair ends in May, and then it'll be handed over to whoever Trump nominates to replace him. It's quite clear from the tone of Powell's statement that he's not going to flinch. The Fed, under his watch, is not going to back down. They're not going to be lent on by the administration. But that's going to leave investors with a lot of questions about what happens once he's no longer leading the Fed. Francine.
Alistair, the Republican Senator Tom Tillis also says he won't confirm any Fed appointees while this is ongoing. So does this present a wider problem from the Fed's functioning?
It doesn't present a problem for the Fed functioning. It does present a problem for the agenda of a Trump administration to stack the board with Trump loyalists. Tillis basically is the swing voter on the Senate Banking Committee. That's split 13 Republican senators, 11 Democrats. If he crosses the aisle to the Democrat side, it's locked at 12-12. It means they can't move anything through committee to the Senate floor. To break that impasse, they need 60 votes from the Senate. They don't have them. So if Tillis stands his ground, it means that Trump won't be able to move any nominee forward onto the Fed board. That's assuming there's a vacancy on the board. If Powell doesn't step down from the board when his term as chair ends in May, there won't be a vacancy unless Trump succeeds in his efforts to fire Lisa Cook, who's a Fed governor. But her case is before the Supreme Court and won't be heard until later this month. And, legal opinion is pretty divided on whether the administration is going to prevail on that. So Tillis' position basically locks things for the Trump administration to stack the Fed board. And in the meantime, you have to look at the market reaction, which has not been favorable and does not aid Trump's goal of lowering borrowing costs or boosting the housing market. Treasury yields are higher since this news broke. That's bad for mortgage rates. Francine.
Alistair, thank you so much. Bloomberg senior editor there, Alistair Bull. Now let's take a closer look at how markets are digesting these attacks on the Fed. We're joined by Bhanu Baweja, chief strategist at UBS Investment Bank. Bhanu, as always, thank you so much for joining us. What a huge day, because this took everyone by surprise, including the Fed, from what we understand. At the heart is Fed independence. What does it mean for, functioning of global markets and U.S. markets especially?
Look, let's start with market pricing. So far, nothing really is priced in terms of the Fed losing its independence. There's been a lot of chatter in the narrative and so on, but if you look at inflation break-evens, if you look at five-year inflation swaps, they're trading in line with or below long-term expectations. So the market is not pricing in a serious risk to Fed independence. And as Alistair just said, it is actually hard to completely change the constitution of the FOMC. 12-member board, 7 governors and 5 regional presidents. It's really hard to change the entire. And even if you get Trump loyalists, remember, Powell was a Trump appointee, Waller was a Trump appointee. So even if you get Trump loyalists, it's not clear that everybody is going to bend and break. Nonetheless, this kind of pressure, again, it's unprecedented, and it does begin to tell on the way FOMC members vote. It was quite interesting that if you looked at the last couple of SEPs from the Fed, even though the FOMC members didn't change their mind on inflation forecasts and growth forecasts, they still took the dots a little bit lower,
right,
which means there's a change in the reaction function, which means that there is a little bit of political pressure that comes to bear. Now, I don't think this is priced in inflation. I think this definitely means higher term premium. And the curve has already been steepening. There's a chance that it steepens further, that you get term premium going up. And of course, as Alistair seemed to imply, that actually means that you actually, unfortunately, see higher rates rather than lower rates, because ultimately what we're solving for is not the front end. This is what I think many investors don't grasp, that even if the Fed was to cut more aggressively or the reaction function changes, if the market feels that this is higher long-term inflation or, in Trump's case, also looser fiscal, that could mean long-end rates and credit risk premium can rise, which means the cost of equity can go up rather than down.
But so what's the right way? When you think about it, and there's a million questions, we have people writing in saying, does it mean that, the president is also just being prepared to fire Jay Powell? I mean, does that go to the heart of the independence, or are the markets also looking through that? It's unclear to me what it would take for the markets to actually understand that things have changed.
I think it'll change. It'll take a big change in the reaction function of the current members of the Fed, right? Because, again, whether or not Lisa Cooks get fired or whether or not Jay Powell can get fired is a legal question, right? That's not entirely up to Trump. He cannot just go in and fire. So, again, I think Jan 21st is going to be a very, very important day, because that's when we're probably going to hear about Lisa Cook. And if the Trump administration doesn't prevail in that, then I think the market will take some solace in this idea that perhaps the current constitution of the FOMC can maintain. Nonetheless, the pressure continues, and that does make for higher long-term rates.
And what does it mean for the next Fed chair?
The next Fed chair is going to be a dove. Look, the Fed, the irony is, Francine, that the Fed itself, including Jay Powell, is a very dovish institution. It's just not as dovish as Trump would want. They don't want to take rates to 1%. I think the next Fed chair will probably speak about a new productivity miracle a la sort of 1990s Greenspan, 1996. As a result of that, the supply curve moving out, the supply in the economy improving, and therefore inflation coming lower. Now, ironically, this is happening at a time when inflation is actually likely to go up, because we're going to get Tuesday, we're going to get the inflation print, and we think the core inflation print is going to be strong. We think it could be like 44 basis points month on month. So it would be a very strange time.
But I mean, this inflation going up, is this an overhang of actually the tariffs, the fact that they're coming back, but at the same time, we're probably importing a bit of deflation from China?
So it's a couple of things. So first, this is a give back to the November print, which was very weak. So the government shutdown is over, and now we're going to get inflation going higher. But you're absolutely right. It's also about the Trump tariffs. And that, we think, is slowly coming from margins onto prices. And that's going to mean that over the next 3 to 6 months, inflation is going to be high. Not a good time to be talking about Fed independence. Ultimately, inflation is going to come lower after that, and probably come lower quite hard. But this is a bad time to be worrying about Fed independence for the market. Again, I think we have to think about what is the cost of equity, not the Fed rate, but the 10-year, the 30-year plus risk premium, all of which the risk premium has been so tight. So I think the one common theme, the motif for this year seems to be may you live in interesting times. The one common theme, to me, seems to be not just a weaker dollar, but more than that, equity vol going higher.
What do you make of oil? And again, does oil feed back into the kind of equity vol going higher as we try and understand exactly what foreign policy looks like in the U.S.?
So Iran is, to the global supply currently, is about 5 times as important. Venezuela produces 0.8 million barrels a day. Iran produces about 4 million barrels a day. Used to produce about 6 million barrels a day at its peak. So if that was taken out, that's a big if, right? I mean, the Straits of Hormuz do not close easily, and they don't close for very long. Even in the Iran-Iraq war in the 1980s, they barely closed for days, right? So if oil production is hit, then you could see.
And this would be because of a regime change, right? Which suddenly is something that people are talking about. We're not making a call, but it's something to watch out for.
People are worried about that. And again, whether or not that happens, it's very possible that in 12 months' time, not much has changed, but I think the Straits of Hormuz shutting down is hard. So where I'm going with this is I think the upside in oil is going to be reasonably limited because the market is already in a surplus, right? I mean, the market is in a surplus to the tune of about 1.9 million barrels a day. It's strange that the curve is not in contango already. The curve is pretty flat to slightly backwardated. But I think the spike in oil should be reasonably limited here, given the surplus.
What's gold today?
Higher, and it's like so.
But it's also it's a hedge against everything.
It's at a time when bond equity correlation has been positive, at a time when many international investors, not just in the public sector, so not just asset managers or supranationals or central banks, but also private companies are thinking about how we diversify away from not just U.S. assets, but also developed market assets. Because remember, the primary trigger for gold to rise in 2022 was Central Bank of Russia's reserves being sanctioned, because that's when everyone sat around the table and said, what is money? If gilts are not, if bunds are not, if treasuries are not, then what is money? And that's what led gold higher. Recently, you're beginning to sense a little bit of froth in precious metals, silver, platinum, palladium, primarily white metals, but again, gold is on the piggyback. Nonetheless, these kinds of events, Fed independence, Iran, it'll be very hard to prevent gold from going higher out here. So you could see some near-term consolidation. We were looking for 47.50. Seems we're going to get there very, very quickly. This has been sort of the fourth year running that we've been long gold. I think the skew is still to the upside. So it's not symmetric around 47.50. I think the risks are clearly to the upside. But
I know you're a great thinker, and we've spoken in the past about productivity. You've just talked about the cost of equity. What are we missing? Because every day there's a big piece of news that actually changes everything in that industry. Yeah. But what's the overarching concern that we should look at? So, Francine, for me, the big question for this year, other than, so we're dealing right now with oil, we're dealing with Fed independence, but I think the biggest question this year is going to be whether, I think everyone acknowledges that AI is going to be transformational. Whether AI is going to be profitable is the big question, right? By which I mean, to me personally, one of the biggest surprises last year was that DeepSeek had no impact on the market. Right? I mean, it had no impact on margins in semis. It had no impact on margins in software companies. As you get more models coming out, as you get more models with lesser compute required coming out, will the margins for AI companies survive, both on the hardware side, both on semiconductors and also on the other side? I think that's the question for 2026. And we're going to be watching sales per employee of non-tech companies, right? The ones who are the consumers of AI, not the producers of AI. So what kind of consumers of AI? So commercial and business professional services, so lawyers and these folks. Yeah. Is there a danger that actually the labor market suffers because of this? Because first of all, there's a big investment in trying to get this AI, and you need less people, and that's not being counted. Joel's data is telling you that there's very limited hiring intentions. So we've been worried about the housing market, the labor market for some time as is. The labor market is weakening, the unemployment rate is going up, and this is where more boring stuff, that the dog that didn't bark last year, which is tariffs, could lead to lower disposable incomes and also move in that direction. Tariffs is a near-term thing, but AI's impact on labor market is very relevant for the longer term as well. Bhanu, thank you so much for joining us. As always, Bhanu Baweja, Chief Strategist at UBS Investment Bank. Now, coming up, we'll be joined by the Director General of RUSI to discuss the prospect of U.S. military action in Iran and Trump's threats to take Greenland by force. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, President Trump says the U.S. is looking at potential options in response to violent crackdowns in Iran. Analysts say 544 people killed and more than 10,000 imprisoned, though Bloomberg has been unable to verify these figures. Well, Donald Trump also says Iran's leadership has reached out to seek talks, and a meeting is being set up, but the U.S. may have to act before the meeting.
We're looking at it very seriously. The military is looking at it, and we're looking at some very strong options. We'll make a determination.
Well, let's speak to Onur Ant, Bloomberg's managing editor for the Middle East and North Africa. Onur, what do we know? Are the protests different this time?
Well, the protests have so far claimed more than 540 lives, Francine. That's according to a human rights activist group based in the United States, and which also says that over 10,000 people have been arrested during the protests that are entering their third week. We know that this is one of the most serious, if not the most serious, challenge facing Iran's administration since 1979. That's when the Islamic Republic was founded, following a popular revolution against the previous regime of the Shah. So far, in addition to the deaths, we have seen that the U.S. President Donald Trump, that we've just seen, has been pursuing his unpredictable diplomacy. On the one hand, threatening with very serious military confrontation, intervention in Iran if the protesters come under violence by the Iranian government. But at the same time, he has also said that Iranian administration has reached out to him to talk about nuclear issues. So that kind of sums sums up both the seriousness of the situation and a possible path forward, judging by U.S. President Donald Trump's comments.
Honor, how would it likely to play out internationally? Again, we look at the oil markets, which are huge in Iran. If there's some kind of regime change, which, as you say, it's the first time that I hear rumors or murmurs about it in the region in a very long time.
Yeah, I think the impact on oil markets, yes, it was significant, but it's somewhat limited as well, because obviously there's still an oil glut in the market, supply glut in the market. But the international reaction to a possible U.S. military operation is somewhat trickier to navigate at this point. On the one hand, you have a bunch of countries surrounding Iran, including some that we could describe as its arch rivals or historic rivals, and even they would be wary of a sudden destabilization of the government, especially if they don't know what comes next. And it is far from being clear at the moment, except maybe for Israel, which has its own very fundamental existential differences with Iran. On the other hand, though, there's a question of how the Iranian people react to a possible military intervention. We have seen back in June, when there was a war between Iran and Israel, that the Israeli and American military involvement there did have an impact on the Iranian population, which rallied around the flag, so to speak, when there was clearly a foreign intervention, which is probably part of the reason why so far, especially Israeli authorities, have been refraining from talking publicly about getting involved in the Iranian protest movement. But at the same time, there is clear public widespread discontent with their current rulers. So it's very far from being clear how exactly the Iranian population would react to such a military operation.
Honor, thank you so much. Honor Onther, Bloomberg's managing editor for the Middle East and North Africa. Now let's continue the discussion on geopolitics with Rachel Ellehuus, Director General at RUSI. Rachel was previously at NATO as the U.S. Secretary of Defense representative in Europe. Thank you for joining us.
Thank you.
I mean, the previous guest said, may we live in interesting times. We certainly have that at the moment. I don't know whether you see actually the possibility of the Islamic Republic being overthrown. I mean, this would be a seminal event that would transform geopolitics and energy markets.
It absolutely would. I mean, we've seen cycles of unrest in Iran since 2009. I think what's different this time is that there are broad segments of society involved in these protests, and it's a combination of those internal tensions as well as external factors in the region driving these protests. So I think it's certainly a possibility, probably not particularly helpful for the U.S. to be threatening strikes that could possibly offer the regime a scapegoat factor there, saying that these were driven by external factors rather than the internal tensions in Iran.
Is there a danger that actually, the Trump administration does something to get access to oil? Like, what do we understand the foreign policy of the U.S. being right now?
Well, I think if you look at Ukraine, Venezuela, the pressure on Denmark and Greenland, certainly the common theme there is the grab for strategic resources by the U.S. administration. So there is definitely that risk that the Iranian regime could play this in a way that suggests that the U.S. isn't interested in democracy or regime change or the welfare of the region, but just a grab for their strategic resources.
I mean, what would be the consequences of a strike in Iran?
Well, the threat of a strike in and of itself can create some pressure on the regime and possibly restrain some of their worst instincts in terms of cracking down on the protesters. But I think, as your previous guest said, there could be knock-on effects in the region, not just for Iran, but Iraq, Israel. I think you'd see everybody getting involved if this isn't contained.
Rachel, the fact that the U.S. action in Venezuela was so swift and actually taking a head of state from, a sovereign country and bring him to the U.S., does that set a precedence really for around the world? Are countries now trying to organize themselves to make sure that doesn't happen to them?
Well, it's really mixed. I think initially people were quite optimistic that removing Maduro, who was not democratically elected in Venezuela, would bring new hope for democracy in Venezuela. But I think what we've seen since is that intervention alone is not going to create stability in Venezuela or anywhere else. So the hard work in terms of reestablishing the power of central government institutions, taking away the power from criminal organizations that have typically been entrenched and intertwined with state institutions, that's something that's going to take time to rebuild. So countries around the world could see a precedent where the U.S. goes in, creates some sort of early peace deal or intervention, but then really doesn't take it further and do the hard work to create that stability and prosperity.
But if you're Russia, if you're Vladimir Putin, does this embolden you because you think you can do the same with Ukraine, or are you scared that the U.S. does the same to you?
In terms of Russia, I've actually been surprised at the muted response from Russia. They were an ally of Venezuela. They are an ally of Iran. They were an ally of Syria, if we look back a year ago. Certainly, they really haven't done much to come to the rescue of their so-called friends and partners. So I don't think Russia has anything to fear in terms of the U.S. getting involved in its near abroad, with the exception of Ukraine, where we do continue to see a lot of engagement from the U.S. administration in trying to work with the Europeans to come to some sort of a peace settlement.
What do you think happens in Venezuela from now? I mean, again, there's been a lot of talk about there's now a threat against Exxon, who said, look, if I get in, it's going to be quite difficult to make it work. So is it going to be much more unstable than we even imagined?
Well, it's positive that what's left of the government is making the right noises in terms of trying to cooperate internationally and create some sense of stability. I think it also matters how Colombia, Cuba, and other regional partners are handled by the U.S. administration. If we can focus on Venezuela and getting things right there and creating a climate for investment and some sense of future prosperity for the people of Venezuela. I mean, when Maduro came in, they lost nearly a third of their wealth. And so I think there is a bright light out there if we can just focus the Trump administration on the hard work after the intervention.
What happens with China?
Well, I'm sure China is watching its interests in Venezuela very closely. A lot of economic interests, a lot of long-term investments. So I think they won't go. Although they're being quiet now, I think you will see Chinese influence come up as we try to make deals on the ground and move forward with extracting that oil from Venezuela.
Rachel, if you look at 2026, how unsettling do you think it will be in terms of foreign policy? I know you're going to be busy, but how do we end up at the end of the year?
Certainly a good market for think tanks, even if not a positive one. This is a continued year of disruption. And I think if we look at U.S. foreign policy writ large, we can see that the U.S. that we knew for many decades, that acted not just in its own self-interest, but for the collective good, and often subsumed its own interests for the collective good, that United States is gone. And we're seeing much more unilateral behavior, much more mercantilist foreign policy. We're even seeing the U.S. in some cases act above the law, both U.S. law and international law, and imposing its own will on other countries. So I think we'll see a continuation of that, the assertion of U.S. interests unilaterally rather than in the collective good. And I think around the world we'll continue to see the erosion of international rules and norms that have constrained the worst behaviors in foreign policy and interventionism over the last few decades. And what you're seeing in Iran, what you're seeing, on the African continent, is a reflection of that instability and that disruption, for good and for bad.
Rachel, thank you so much for joining us. Rachel Ellehuus there, Director General of RUSI. Coming up, Friedrich Merz says the geopolitical uncertainty is reason to strike up closer ties with India as the German Chancellor makes his first trip to Asia. We'll be live in New Delhi next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Fed Chair Jay Powell vows to stand firm as the Trump administration threatens criminal charges in a dramatic escalation of tensions. President Trump says the U.S. is considering some very strong options in response to the deadly crackdown in Iran. Security forces there say they've regained control across the country. Plus, the German Chancellor Friedrich Merz is set to sign deals on tech, defense, and critical minerals during his first visit to India. Now let's get more on that story. And Friedrich Merz says the world should brace for more uncertainty with the return of global power politics, and is urging closer economic ties and security ties with countries like India. He made the comments alongside the Indian Prime Minister Narendra Modi on his first trip to Asia since taking power last May. Let's bring in Nasrin Syria, Bloomberg's managing editor for South Asia, and our Oliver Crook, our chief Europe correspondent. So thank you both for joining us. Nasrin, what's been agreed between the two leaders?
Well, we've seen today 10 agreements being signed, spanning a range of sectors from critical minerals to defense. The two countries have pledged stronger economic and security ties. We've also seen talk on ongoing negotiations regarding the European Union and India's free trade agreement. Both sides have pledged to speed that up, and we're looking at possibly a deal later this month. That has been key. I think for both Germany and for India, it's important, given the geopolitical changes that we are seeing, to forge these and to showcase these stronger ties. We heard Merz talk about growing power politics in the world and the need for these two countries to forge these closer ties. I think Germany sees India as a strong partner. India is the most populous country in the world. It also is the fastest growing major economy in the world, and Germany sees India as a key economic partner. So a lot of business deals, a lot of security ties on the table in these talks.
And Ollie, Merz has been under pressure at home and is also struggling to reduce Germany's dependence on China, for example, for raw materials. So how important is this visit for the Chancellor?
Yeah, not just on China, but also the United States now a sort of unreliable partner for Germany in much of the world, certainly on issues of trade and potentially on issues of defense. And for Friedrich Merz, in his first trip to Asia there in India, talking really about expanding defense ties with India, but also economic ties. We'll give you an example of one of the main deals that we've been watching, that we've had reporting on, an $8 billion submarine deal that the Indians might be buying from Germany in a sort of joint venture by ThyssenKrupp Marine, in one of the biggest orders that the Indian government has ever put forward. And this really highlights a couple of things for Germany. Germany is trying to find new export markets now that, the Chinese economy has really grown substantially and is potentially tapped out, trying to maybe push some of the Western industry out, is trying to find new markets of growth. For example, when you look at Germany and China, they do about $200 billion worth of trade every year. If you look at India and Germany, it's about $30 billion. So there's a lot of scope for growing that over the next couple of years. And that is going to be a big focus for the Chancellor of Germany, who's trying to find new export markets. And particularly why India is so attractive is it's a nation that is also industrializing at a fast rate. For a lot of these companies in Germany and across Europe, they build a lot of the machinery that goes into some of these factories. So there's a huge opportunity there as far as the Germans are concerned for an economy that, as you know, Francine, we've been talking about for years now, has really stalled out.
Nasreen, how does this visit actually play into India's relationship with the U.S. and Russia?
So with the U.S., I think Prime Minister Modi, what he's been trying to do is to build these partnerships with other countries in order to offset the sort of weakening relationship that we've seen between the U.S. and India. The U.S. has slapped 50% tariffs on India. We've seen India's exports to the U.S. really take a hit. The U.S. is India's biggest trade export market, and so we are seeing India trying to develop these other trade agreements with countries to diversify its export basket. The European Union is key to that. As mentioned, they are discussing finalizing this free trade agreement that will really unlock investment and trade for both countries. Aside from that, we are seeing the security relationship also improve. As Ollie mentioned, the submarine deal that we wrote about last week, this will be key. It's not just the manufacturing of the submarines, but it's the technology transfer that will take place in this deal. It will be the first of its kind, and it will be a real game changer for the relationship there. On Russia, it's a little bit more complicated, and India does have long-standing historical ties, political and economic ties with Russia, and we're not going to see that changing anytime soon. But I think what Germany is trying to do is making the argument to India that we can provide the defense equipment to you. You can slowly reduce your reliance and your dependence on Russia in that way.
Ollie, Merz is also pushing on behalf of the EU for a free trade deal with India. Is it any closer?
Yeah, that's right. I mean, he made a few comments, a couple of minutes ago, saying that urgently they need to conclude that free trade agreement between India and the European Union. A little bit of history on that. That is a negotiation that began back in 2007 and died in 2014, has been revived in 2022, and was really supposed to be inked at the end of last year, and now has been pushed into potentially being signed this month. So that likely, potentially will happen as a signing ceremony in India on January 26th, when Ursula von der Leyen is going to go over there. And again, it speaks to what the Europeans are trying to do, build out the free trade apparatus. Now that the United States is unreliable, we now have the Mercosur deal with Latin America that's crossed over the line, that will likely be signed by the European Union, and India is another fertile market for them, a massive economy that is growing at a very rapid pace with a huge market.
Thank you both for joining us. Bloomberg's Chief Europe Correspondent Oliver Crook and our Managing Editor for Southeast Asia, Nazreen Syria. Now, the European Union and Mercosur have finally agreed a trade deal after negotiations that began 25 years ago. The deal with the South American bloc of Brazil, Argentina, Uruguay and Paraguay will create a free trade area large enough to rival the North American arrangement known as USMCA. It will gradually erase tariffs on agricultural goods and other products. And Bloomberg understands that the UK and Germany are leading a European push to discuss plans to increase a military presence in Greenland to show President Donald Trump the continent is serious about Arctic security. Speaking aboard Air Force One, President Trump insisted one way or another the U.S. would get Greenland.
If we don't take Greenland, Russia or China will take Greenland, and I am not going to let that happen. Sure, I'd love to make a deal with them. It's easier. But one way or the other, we're going to have Greenland.
Well, let's bring in Sanne Was, Bloomberg's Copenhagen reporter. Sanne, what's the mood in Denmark, and are there concerns about what a bigger military presence in the region might look like?
Yeah, the biggest concern for Denmark and for Greenland right now, that is Trump and whether he might move to take Greenland by force. So any move by European allies that could potentially de-escalate this situation would be very welcome news here in Denmark. Denmark has said it's open to allowing more U.S. military presence in Greenland, and now the UK and Germany, they're pitching this joint NATO Arctic mission in the territory. Now, officials here in Denmark haven't specifically commented on these plans, but they have long pushed for NATO to take on a more active role in defending Greenland and in part to reassure Trump that defense there is taken care of. So no doubt that this will be welcome news in Denmark, even if some military experts say a mission that doesn't necessarily make sense.
Senate, what is the likelihood of officials tempering President Trump's interest in Greenland when they travel to Washington this week?
Yeah, the Danish foreign minister and Greenlandic foreign minister, they will meet with Marco Rubio. We hear reports now that it will happen on Wednesday. There is a worry among some Danish lawmakers that this meeting could actually just make things worse. I mean, Danish and Greenlandic officials are arriving really banking on this meeting to be the start of a diplomatic solution to this spat. And they're hoping to clarify things and essentially dismantle Trump's argument for why he needs control of Greenland. The problem is if Danish officials arrive with rational arguments and logic, because that won't necessarily work on Trump. I mean, just last night, Trump said it's not enough to lease Greenland. It's not enough to have it short term. He wants to own it. Denmark and Greenland have drawn a clear red line on that. So there is a risk that this meeting will just end in an impasse and a worry of what then might happen next.
Thanks so much, Sanne Was, there, Bloomberg's Copenhagen reporter. Now let's return to our top story. And Fed independence is in focus after the Trump administration threatened criminal charges against the central bank over the renovations of its headquarters. Let's bring in Bloomberg MLive strategist Ven Ram. Ven, good morning. So the sentiment this morning seems to be sell America, but it's also not huge.
Morning, Francine. Yes, absolutely. The theme is unmistakable. I think that, we are seeing a pronounced kind of reaction in the long end of the Treasury curve with the 30-year yield approaching 5%, although we are kind of not exactly close, but we are getting there. And I think that if this risk aversion continues, we'll get there at some point in the next few weeks. The question, though, is what this means for other assets, U.S. assets. And I think that the U.S. dollar is also on the back foot this morning. I think the risk premium on the US dollar is pretty palpable now. At the moment, it's about 3% on my model values. And I think that, that risk premium has the potential to widen because, next week or probably the week after that, coinciding with Davos, Francine, we will have the White House nominate the next Fed chair, and if that chair happens to be very dovish, overtly dovish in the face of inflation data that we are bound to get this week that may show a sticky inflation, then what does that mean for monetary policy, credible monetary policy in the US? It's not very credible to keep cutting rates when inflation is already above target. So all that is going to revive the scepter of sell America trade. That means a weaker dollar and higher treasury yields.
What impact, then, could this have on the dollar's role in the world?
Well, I think that, the dollar is not going away in any hurry. I think that, the dollar is still the predominant trading currency in the world. It is embedded into the plumbing of the world's financial system. So the dollar is not going to go out of fashion, but that is not to say that it's not going to decline further. I think that, it has had 2 quarters of successive gains, but this quarter looks particularly challenging because investors are likely to bring back the hedges that they had put on, say, in the first and second quarters of last year. I think they are going to revive those hedges because, with so much of policy uncertainty and geopolitical uncertainty opening up in the world with reference to Iran, I think that, people are going to put on those risk hedges, revive those risk hedges, which is going to be negative for the dollar in the short term.
Gold spiking further. Is 5,000 in sight, then?
Well, it certainly seems that way. I mean, you've got a confluence of factors working in favor of gold. First of all, the dollar risk premium is positive for gold. You've got geopolitical tensions in Iran, which is again positive for gold. And if you have the sell America trade, that calls into question the value of fiat currencies, non-fiat currencies, which is gold, will do very well. So it looks like the next 10% upside for gold is very much on the cards. But of course, when the market positioning is so overwhelmingly positive for gold, you've got to think and ask the question, what could go wrong? So investors would do well to look for some downside protection because volatility can't be too far away when you have this crowded positioning in favor of gold.
Ven, as always, thank you so much for all of your commentary. Bloomberg M-Life strategist Ven Ram. Coming up, we'll look at the impact of protests in Iran and developments in Venezuela with, of course, oil market expert Nadia Wiggen from Svelland Capital. That's next, and this is Bloomberg. Conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, President Trump says the U.S. is looking at potential options in response to violent crackdowns in Iran, which analysts say has seen 544 people killed and more than 10,000 imprisoned. Those figures could not be independently verified by Bloomberg. Now, the potential for regime change in Tehran could have a seismic impact on security in the region and global energy markets. So let's discuss all of this with Nadia Wiggen, director of Svelland Capital, a hedge fund that focuses on commodities and freight markets. And in a second, we'll also have our great reporter on individual companies. So, Nadia, give us a sense, first of all, of where you see the price of oil going. Is there a danger that it gets very volatile, as Iran is also a huge supplier, and we're now, for the first time in recent memory, talking about a potential regime change?
Absolutely. The market has really been in a selling pattern for the last few months. And so the market is definitely balanced towards the short side. And now we have geopolitics really taking center stage, led by Iran, questions about Venezuela, and finally Russian production and exports as well.
what happens, Nadia, if you go to Venezuela? What do you think will happen in Venezuela in terms of actual oil production?
Well, right now, what we see is that we've been having this blockade. We've had exports of Venezuelan oil drop to 300,000 barrels per day from around 700,000, 800,000 barrels per day. We now are hearing from the Trump administration those exports will resume. In the near term, we really need big investments in Venezuela to make any kind of difference in the medium term in terms of production. But right now, what we're looking at is that China may be unable, and they've been buying 45% of Venezuelan oil, to continue to secure that oil at huge discounts. Because if the U.S. government is acting as a go-between, they're going to want the market price, or those will just be imported into the U.S., those barrels, and therefore China needs to source non-sanctioned barrels to replace that Venezuelan crude when Iranian and Russian barrels aren't that easy to deliver.
But Nadia, give us a sense, Iran is 4 or 5 times more important in terms of the millions of barrels that it has on the market. I think at some point it was also producing 6 million. Like, how important is Iran right now to global energy markets? And what are the chances that the Strait of Hormuz would actually be closed?
Yeah, so the production exports out of Iran, we saw a peak at around 2.15 million barrels per day worth of exports out of Iran last year. But it has dropped down to, sub 1 million barrels per day for periods of time. Right now, the biggest question is if Karg Island were to be attacked, because that's 28.5 million barrels per day, million barrels of storage right there, that it would really be a shock to the system if, let's say, something happened there and exports couldn't happen. The market is hugely unprepared for a closing of the Strait of Hormuz, the shipping markets, so forth. The cost of insurances in an already very strong shipping market, it would actually be quite catastrophic given the positioning in the oil market right now.
But is that possibility at 5% now, or has it just gone higher because of the big protests and the fact that also the U.S. is talking about a possible strike, which we don't really know whether to take them at their word or not?
Well, it is an increased percentage, but of course the U.S. government would not want these Straits of Hormuz to be shut, right? It's a #1 naval exercise by the U.S. to protect those. But of course it is a possibility. Again, would Iran really want to do that? It would very much irritate its neighbors. So it depends what the rest of the neighboring countries want. There's also a big concern if things were to change in Iran, what would happen afterwards? Would there be a power vacuum? So I think the scenario we're really looking at is reduced outflows of Iranian oil and possible temporary halts, but not a real closing of the Straits of Hormuz.
Okay, Nadia, stay with us because President Trump, meanwhile, has criticized oil giant Exxon over its response to his push to extract oil from Venezuela. On Friday, the chief executive, Darren Woods, called Venezuela uninvestable during a meeting with the president and oil industry executives at the White House. Well, Trump fired back late on Sunday.
No, I didn't like Exxon's response. We have so many that want it. I'd probably be inclined to keep Exxon out. I didn't like their response. They're playing too cute.
Let's bring in Mitchell Furman, Bloomberg's oil reporter. Mitch, bring us up to date. Good morning, first of all, but bring us up to date with developments and why Exxon is, I don't know whether it's playing it safe or they are just not that interested in Venezuela.
Yeah, good morning. We heard from major oil executives at the White House on Friday where, we heard optimism, we heard caution as President Trump looks to get a deal with them done to reinvigorate Venezuela's oil industry. ExxonMobil is the largest U.S. oil company, and they did call it uninvestable because of the current commercial and legal frameworks in place in Venezuela. Those need to change in order for it to become investable, he said. And, these companies think in decades. They need stable regimes in order to make long-term major investments. $100 billion is a lot. I mean, Exxon as a company spends less than $30 billion a year. Chevron, ConocoPhillips, these companies need a path to clear returns, and even Harold Hamm, who was a major donor of President Trump and is a U.S. shale tycoon, he said this excites him as an explorationist, but at the same time there is a lot of work that needs to be done for him to get involved.
I mean, Mitch, the problem is that you want to please the president because you don't want retaliation, but at the same time, if it doesn't make commercial sense, you may want to speak up. So what are Chevron and other Western oil companies saying?
Yeah, Chevron already produces in the country, as we know. They're the only U.S. company there, and they produce more than 200,000 barrels a day, and they say they can raise their production by 50% in the next 18 to 24 months. Longer term remains to be seen how much investment they're willing to make. They take a similar approach as Exxon and other competitors, that they do need that stability to invest long term. But we also heard excitement from the likes of Repsol, Spain's oil company, the oil field services companies such as Halliburton and SLB. They're excited. Some private folks such as Armstrong. So there is excitement, but there's also the caution of, if we're going to be putting big dollars in place, we need secure paths to return and safety for our people.
Yeah, and again, I guess the concern is you don't know politically what happens. Mitch, thank you. Mitchell Furman there, Bloomberg's oil reporter. So let's go back to Nadia Martin-Wiggen. Nadia, this is what we were saying, that actually we don't really know what happens in Venezuela. We don't 100% know what kind of political stability we have. Do you expect what needs to happen to have security in the energy space in Venezuela? It's infrastructure, it's investment. I mean, do you have any idea of what terms could be palatable for some of these companies?
Well, number one is security, so safety of workers and so forth. Number two is that there's some longevity of a plan in place. So I think that's part of it. But I think also what the oil companies want is for maybe the Trump administration to push things, because currently PDVSA, they have to own 50% of the resources. They have to be the operators, and the companies, the foreign companies, would love to have more control of that. So I think that is part of the focus. So it's not necessarily a no. It is looking at what are the potential guarantees they can have there. At the same time, we have to remember that E&P companies have hugely outperformed the oil market last year. They were up. Exxon was up. The oil price was down. And what they have is a lot of pressure to continue paying dividends, because after COVID, when they cut dividends, people and investors left this space. So they have to watch their CapEx and their returns. And that is where they are very worried about investing a lot of money. Of course, the oil field service companies, well, they're on a contract, right? So they can leave. They're not taking the big risk. So that's why Schlumberger and so forth would be more positive.
Nadia, we only have a minute and a half left, but I guess the biggest question is, you have China stockpiling, you have also Mark Harding traveling, I believe, to China to try and sell exports to China directly. How different do you think the energy supply chains or the oil complex will be by the end of the year?
Oh, that absolutely. Different trade flows are something we should expect. And that is what we've seen, with all sorts of war conflicts and going forward. Right now, we have the U.S. Congress voting on 500% tariffs, possibly on rebuying Russian crude. India is stepping away from Russian crude. They were buying tenders into year-end. Reliance hasn't bought a single Russian barrel so far this year. So that trade flow could be really shifted. Canada is focused on Asia. We have OPEC increasing supply and now pausing. And this is where the demand picture will really come forward. So where we've had this two-tier market between sanctioned crude and unsanctioned crude, we might be in a much more normalized market again.
Nadia, thank you so much for joining us. Nadia Martin-Wiggen, their director of Svelland Capital. Up next, Bloomberg Brief, and this is Bloomberg.